The Banasa Prize is awarded annually to European economists under the age of 40 who have made outstanding contributions in the fields of macroeconomics and finance. This year's prize winner is Ralph Cohen for his influential research on the pricing of risk in equity and insurance markets. And it's my great pleasure to introduce Ralph to you. Ralph is currently Professor of Finance at the University of Chicago Booth School of Business and was previously awarded the American Finance Association's 2019 Fisher-Black Prize. Ralph also serves as co-editor of the Review of Financial Studies and is a research associate at the National Bureau of Economic Research in the US and a research fellow of the European-based Center for Economic Policy Research. It's a great honor to have been asked to chair today's ceremony and to honor Ralph. The more so because Ralph and I share the same nationality. We're both Dutch. We also share the same alma mater, Tilburg University in the Netherlands, where both of us studied econometrics and finance. From there, Ralph went on to teach at the Universities of Chicago, London Business School, New York University, and then back again to Chicago. Ralph is an unpretentious and reserved person who has a contagious passion for original research. With unflagging energy and unwavering commitment, he has pushed the boundaries of knowledge on asset pricing and insurance markets, while the profession was largely focused on banks and capital markets. In this sense, Ralph was ahead of his time and in line with the gradual shift in financial activity away from banks to insurance companies and other non-banks. Ralph turned 40 earlier this year. Sorry, Ralph, for giving away your age. But I was just in time to still be eligible for this year's prize. To give you a sense of Ralph's early signs of academic talent and productivity, one needs only turn to his famous PhD thesis. His thesis contained 6 chapters on asset pricing. Chapter 1 was subsequently published in the Review of Financial Studies. Chapter 2 in the Review of Finance. Chapter 3 in the Journal of Finance, the top journal in the profession. Chapter 4 in the Journal of Financial Economics. Chapter 5 again in the Journal of Finance. And Chapter 6 also in the Journal of Finance. Enough to get tenure at many business schools. No wonder Ralph graduated at Tilburg University with highest honors. Before we turn to the prize ceremony, Ralph still has some work to do today. He will deliver his keynote speech on the risks in the equity and insurance markets during the low interest rate environment. This will be followed by a discussion and questions from the audience. We are very pleased to be joined by Professors Helen Ray from London Business School and Motohiro Yogo from Princeton University, who will each offer comments to kick off our discussion. Both Helen and Motohiro have worked with Ralph. Helen co-authored a report with him on strengthening the Eurozone, and they were colleagues at London Business School. And Motohiro has published many articles with Ralph, and the two are currently working on a new book on the financial economics of insurance, which is under contract with Princeton University Press and should come out within a year. Ralph's keynote speech today will last 20 minutes, followed by interventions by Helen and Motohiro for 15 minutes each, and the remainder of our time together until 1750 European hours will be left for an open discussion with you, the audience. You can use the raise hands function to indicate you want to raise a question, and I will make sure you can pose your question. You will receive in advance then a message from the organizers that you can unmute and pose your question. I also want to draw your attention that today's event is joined and open to the press. And with that, Ralph, the floor is yours. We're looking forward to your keynote. Thank you.
Okay, wonderful. Well, thank you so much, Luke, for the very kind words, and for the committee for recognizing our research. We're delighted to receive this award. And also a special thanks to Modo and Alain for being here today as well. So I'm going to talk about insurance markets in the low rate environment. And so let me just sort of start off by sort of motivating like the importance of insurance companies more broadly. So insurance companies play an essential role in allowing households and firms to share idiosyncratic risks among one another. And just to sort of like think about the kinds of risks that we have in mind here, we're really thinking about true tail risks. So you think about life and health events and things like that. And so we have shown in sort of an earlier work that mistakes that, for instance, households can make in insurance portfolios tend to be much more costly than mistakes in their investment portfolios, so the allocation from stocks to bonds, let's say. And so a well-functioning and stable insurance market is important for households and for firms. Now, in addition, given the fact that insurance policies tend to be prepaid, insurance companies receive premiums up front and pay them out at some event in the future. So insurance companies manage large pools of capital, and as a result, they're like important players in financial markets as well. Now, it's important to realize that insurance companies, modern insurance companies, do not just insure idiosyncratic risk. Instead, modern insurance companies play an important role by offering long-term savings products with minimum return guarantees. And in the US, they go under the name of variable annuities. In Europe, they may be more familiar as profit participation products. Part of that demand is coming from the fact that defined benefit pension plans have been sort of declining over time. And there seems to be a strong demand from households to share in the upside of the market while still being protected in some way on the downside. Now, as a result of that, life insurance companies now, they insure quote unquote aggregate risks. And given the long-term nature of these insurance contracts, one really has in mind like retirement savings products, the pricing and risk management of these products are really, really difficult. And they require complex financial engineering. And we have seen that in case insurance companies don't hedge perfectly, which may be driven in part by model risk, it may be driven by regulation to some extent, it leaves insurance companies exposed to movements in financial markets, and in particular to declines in interest rates, declines in stock market values, and spikes in volatility. And so these risks were first on display during the 2008 financial crisis. So we've seen several life insurance companies during that period receive government support. Of course, AIG was the most salient one, but many others received support as well, both in Europe and in the US. Now, one of the sort of main findings that we have around that period is that once insurance companies are constrained, perhaps not to the point where they need government support, but once they get constrained, insurance companies start to distort the prices of life insurance and annuity products. And they do so during this period in surprising ways. So what we found is that they're actually lowering the prices of annuities and life insurance by large amounts. And it may seem puzzling at first why an insurance company that is constrained, why it would ever lower its prices. What we show is that there was a gap in a way, think of it as like a mistake in the regulation where the regulatory discount rate went up during that period. What that meant is that if insurance companies sell $1 worth of insurance, they have to record a much lower value on the liability side of their balance sheet. So essentially, they can relax regulatory capital constraints by selling these policies that are too loosely regulated. And they took advantage of that by lowering these prices by a lot. And of course, while this sort of extraordinary pricing behavior relaxed regulatory constraints, it weakened their economic positions because they were selling these policies at a discount. Now, there's two insights from this research that are broadly relevant, I think. First, like raising regulatory discount rates during times of stress can have unintended consequences because once insurance companies get constrained, these discount rates start to affect the pricing behavior of insurance companies. And this fact is useful to keep in mind when thinking about one aspect of the Solvency II framework, which is the volatility adjustment. The second sort of insight, which is perhaps broader, is that insurance companies at times get constrained, and that has an impact on their pricing behavior and broader implications as well. And so it's not this like rock solid set of institutions that we typically think about, and there's perhaps like a lot more risk in this sector than we have appreciated before the financial crisis. And so following the financial crisis, we entered the low rate environment. And so like faced with like interest rates short rates that hit zero, central banks all over the world sort of implemented various forms of quantitative easing and large scale asset purchases. This in part had an impact on long-term interest rates, which was of course the goal. But this put further stress on the life insurance sector. To give you a simple example, for the bonds that have little credit or sovereign risk, if an insurance company holds the bond until maturity, then what, for instance, QE will do is it's going to push up the price today, but the long-run return over the life of the bond will be unaffected. Again, when there's little credit risk or sovereign risk. And so if the long-run returns are little affected, but once they have to reinvest the capital as the bond matures against the lower yield, the insurance sector will be weakened. And so what I'm going to show you is two pieces of evidence that the insurance sector has remained fragile since 2008. I'm going to look at sort of the sensitivity of equity returns to interest rates, and I'm going to zoom in on the COVID-19 crisis last year. Now, the main takeaway from both of these analyses is that the insurance sector got constrained in 2008 and essentially remained constrained for more than a decade that followed. This is quite different from what we know from other intermediaries. So if you think about, for instance, banks or the run on money market funds or the run on corporate bond mutual funds last year during the COVID crisis, then we see these very sort of short-term episodes with lots of turmoil. We see large flows, let's say, out of corporate bond mutual funds, big spikes in spreads, and those get a lot of attention. In case of the insurance sector, it's much more like a constraint that binds for a long period of time, and that for that reason may have actually longer lasting effects. I'll revisit that in a little bit. But first, I'm going to show you some additional evidence that the risk profile of the sector has changed quite a bit. So what you see over here is the risks in the stock returns of insurance companies. I'm going to show you two periods. One period is before the financial crisis, and then the second period is following the financial crisis. So what you see over here is that a regression essentially of the returns of insurance companies on the market return and on the return on a 10-year bond. How do you interpret these numbers? So before the financial crisis, this coefficient of 0.6 means that if the stock market as a whole falls by 10%, then this is typically associated with a decline in the stock prices of insurance companies by only 6%. Following the financial crisis, this number doubles. So now the same 10% decline in the stock market tends to be associated with an 11% decline in the stock returns of stock prices of insurance companies. If we look at the sensitivity to interest rates, there's something even more remarkable. Before the financial crisis, there's little to no sensitivity to interest rates, and the relationship is statistically insignificant. Following the financial crisis, we get this very strong association between movements in long-term interest rates and the stock prices of insurance companies. At this point, a 1% decline in the long-term interest rate leads to an approximately 13% decline in the stock prices of insurance companies. And so now insurance companies are very sensitive to movements in interest rates. If we then look at European life insurance companies, and this is based on work that Modo and I are currently doing, then we see a similar phenomenon. So I'm looking here at the period following the financial crisis from 2011 to 2019. But I'm also showing you the results for the later sample starting in 2014 and then starting in 2017, which is well after the European sovereign debt crisis and when interest rates are unusually low in the euro area. So what you see is that, again, the market beta is close to 1, meaning that a 1% decline in the stock market is associated with approximately a 1% decline in the stock prices of insurance companies. But the other thing you notice is that you see this increased sensitivity to interest rates. And so at this point, the 1% decline in the long-term interest rate in the euro area leads to an approximately 6 to 7% decline in the prices of equity prices of life insurance companies. So again, you see the same sensitivity. If we then zoom in on the COVID-19 crisis, then again, you see the fragility of the sector. What you see in the left panel is a decline in stock prices. First, for the market as a whole. So the market as a whole, as we know, during the first quarter of 2020, fell by a little over 30%. If you go to the financial sector, which includes banks and insurance companies and other financial institutions, it fell by a little over 40%. But quite strikingly, if you go to life insurance companies, and in particular those that are active in this market for these long-dated return guarantees, their stock prices fell by more than 50%. In fact, it's closer to airlines than it is to the market as a whole. Okay, and so airlines fell by a little over 60%. If we then look at sort of a breakdown of like where the losses sort of like were concentrated, we see that it's really the large insurance companies, and it's like Lincoln, it's Brighthouse, which used to be MetLife, AIG, and so on. And some of these companies experience losses in their stock price like over 60 to 70%. Now, what is remarkable is that there's a very strong association between the decline in stock prices in 2008, the decline in stock prices during the COVID crisis, and the balance sort of the balance sheets of these companies, and in particular, like how many sort of minimum return guarantees they have underwritten in the past. So what you see over here on the horizontal axis is the decline in the stock price during the financial crisis. The vertical axis is a decline in the stock price during the COVID-19 crisis, and you see that those line up very well. On top of that, the largest 9 insurers in terms of variable annuity liabilities in 2007, they coincide with the largest 9 insurance companies that experienced a decline in their stock prices in the COVID crisis more than a decade later. And so the picture that emerges is that these companies underwrote some of these minimum return guarantees like well before the financial crisis. Then they were shocked by the events during that period and the subsequent low rate environment, and the sector has been stressed sort of ever since then. Now, what are the consequences of that potential? There's going to be sort of 2 important dimensions. First, there's a large literature that shows that once insurance companies are constrained, they modify their allocation in terms of like how they invest these premiums, how they allocate their assets. And so following 2008, you see that the duration of their asset portfolio increases, and the credit risk that they take is going down. Now, given the fact that these contracts have this very long duration, you get a shift in their asset demand for like a very long period of time. And so that means that prices may be affected for like a longer period of time, and the real consequences may be longer lasting as well. Okay, so it's going to be less salient than these very flashy episodes where something happens during a short period of time with a subset of institutions, but the real consequences may be just as important, given the fact that this is very long-lasting effect. Now, the second consequence is that once insurance companies get constrained, they start changing the prices, as we already saw before. They change the design of the insurance contracts, and they actually may change their reinsurance decisions. And in particular, in the United States, this is less of an issue in Europe, as I understand it. But in the US, insurance companies can use like reinsurance to effectively move like liabilities off their balance sheet, and that reduces transparency. So what we see is that those companies that get constrained sort of use those off-balance sheet activities more, and it reduces transparency of the industry. I'm going to show you a little bit more on how insurance companies have responded since the financial crisis once they got constrained. So the first thing over here is what happens to the pricing of these minimum return guarantee products. So you see that this is the price that households in the US would have to pay for these minimum return guarantees. It was about 50 basis points. But then following the crisis, it jumps up and it essentially doubles, and it stays at this much higher price level. So prices are being affected by this shock. On top of that, once insurance companies get constrained, like many of them sort of like decide to drop out of this market. That could be because they are constrained themselves. It could be the case because they think that sort of like managing these risks is simply too challenging. And so you see that a lot of them joined before the financial crisis and subsequently exited the market. Now, if you put all of this together, the picture that emerges is one of a kind of a supply side theory of insurance. That's how we want to think about it. Traditionally, if you think about the literature on insurance markets, then the kinds of products that we focus on are life and health insurance and traditional annuities. Insurance companies are seen to insure idiosyncratic risk, and the frictions are informational. It's either adverse selection or moral hazard. Now, we know that literature sort of like leads to variation, sort of like predicts variation in prices, like contract characteristics, and it can lead to some degree of market incompleteness. We're suggesting sort of a complementary view, and I want to emphasize the complementary part, where the products that are important are these minimum return guarantees. What insurance companies do is they insure this market risk. The frictions that we care about are financial and regulatory frictions, and to some degree, sort of imperfect competition and hence some market power that insurance companies have. And that theory also leads to variation in prices, contract characteristics, and as I showed you, some degree of market incompleteness. And so to get a sort of like a more in-depth understanding of insurance markets, accounting for both these frictions on the demand side and the supply side, we think is important. I want to conclude this part by talking about risk regulation. And there's surprisingly little work on that for life insurance companies, in particular in light of what modern life insurance companies do. That may be tempting to sort of like import insights from the banking literature, which is probably a good idea to start with. But one key sort of difference between banks and insurance companies is that, with like some exceptions, like the liabilities of insurance companies cannot be run on. And so given the long-term nature of these liabilities, the same kind of like theories and arguments suggest that we should be looking for long-term risk measures, like long-term expected shortfall or long-term value at risk. Now, while conceptually clear and appealing, sort of implementing those measures in practice is actually very difficult, because what those measures depend on is a regulator's view on mean reversion in interest rates and other asset prices. And those are very difficult to measure. And so really, if you start thinking about regulating insurance companies, you're balancing or you're trading off sort of the fact that you don't want insurance companies to act in a manner that's too pro-cyclical, but at the same time, you want to account for the fact that you may not be able to measure very well some of these key inputs into these long-term risk measures. Okay, and so there's a lot of open questions here that are worth exploring in future research. Okay, for the last couple of minutes, I want to switch gears and tell you about a line of work that I've been working on with Stijn van Nieuwenburg that I'm very excited about and that I think could have broad implications. To motivate this, I'm going to sort of like start with like two facts and a key question that motivated this. So the facts are that there's been a lot of progress in several areas of medicine that lead to like meaningful and durable gains in longevity. Okay, it's sort of needless to say, given like all the innovation we've seen in the last year with the vaccine, sort of like how much progress has been made. But this is much broader than that. Okay, and the issue though is that in a lot of cases, those new medical treatments tend to be very expensive, and so depending on the healthcare system, patients may face like very high out of pocket expenditures. It may lead to financial toxicity, meaning that maybe you can ultimately get it, but in order to get it, there's a lot of like stress and anxiety that leads to like adverse health outcomes. And in some cases, patients simply cannot access some of these frontier treatments. And so the motivating question is like, how do we assure access for all to these medical frontier technologies? And there's been sort of like two solutions in the literature so far. One sort of very natural one is to turn to health insurance. Now, health insurance, faced with like rising costs, has increased copays. Copays traditionally are there to limit moral hazard, to make sure that for instance, like patients don't visit the doctor too often. But if you think about sort of like life-threatening diseases like cancer, which is going to be our application, then moral hazard is really not very relevant at all. Now, the other thing is that like health insurance may not cover all of the treatments, and as a result, you cannot access some of them. One suggestion that has been made in literature is to use credit markets, and they refer to that as like life loans. The challenge with that is that once you're diagnosed with, let's say, late-stage cancer, it's very hard to pledge your future labor income. And so that means that it's very hard to get a substantial loan, and you still may not be able to access those treatments. So our suggestion has been a different one, because we got concerned that sort of like under the status quo, we face sort of a rather dystopian future where these life-saving treatments have been developed, but they're unavailable for a large segment of the population. And this issue is going to get worse as the population ages. There's going to be new treatments that become available. They're more effective. They're more often used as first-line therapies. These treatments are getting like increasingly more expensive. They tend to rise, sort of the prices tend to rise faster than incomes. And of course, this challenge is sort of like even more, more severe, given the fact that the fiscal position of governments has worsened in recent years in many places. Okay, so what is our suggestion? The idea here is that the discussion so far about affordability involves like health insurance companies, it involves patients, and it involves the government. The group that has not been sort of like involved in these discussions at all is life insurance companies. But in fact, life insurance companies experience a very large windfall on existing policies as a result of these life-extending medical innovations. And the idea here is the following. Imagine that something were to happen to me and I get diagnosed with like some disease that is life-threatening. Then at the moment that I would be able to get this treatment, then the insurance company is going to benefit in two ways. One is that the payout will be pushed far into the future. And secondly, during that period that I'm still alive, I'm still able to make sort of premium contributions, which counts as income to the insurance company. And it turns out that those effects are like really large. So in our paper, we study recent cancer innovations, and I'm just giving you one example here to show you orders of magnitudes. So what you see is that the benefit per dollar of face value, this is for stage 4 melanoma, is very large. So if a policyholder gets this treatment, the insurance company gains 48 cents per dollar of face value if the policy was purchased at age 30 and the patient is diagnosed at age 30 as well. Even if you're diagnosed at age 50, the benefit to the insurance company is still 37 cents per dollar of face value. And so that means that if you take the total cost of this treatment, which is $159,000, an insurance policy of $369 would be sufficient. If you look at just the out-of-pocket expenditures, it's $20,000, and a policy of just $46,000, which is very, very common, would be sufficient. And so there are these like opportunities available in the life insurance sector. And so how could we use those? One option is to say, well, if consumers have all the bargaining power, then what insurance companies would simply do is to cover all of the out-of-pocket expenditures of their policyholders. What we compute is that the total gain to insurance companies would be 9.8 billion. And it exceeds the aggregate out-of-pocket cost of 4.8 billion. So there's a solution where the insurance companies would profit by about 5 billion, and all of the policyholders would have access to those treatments. Now, if instead insurance companies have all the bargaining power, then they want to make sure that they get these treatments and have frictionless access to them, either through loans or by reducing the face value. So the longer term implications of this, if you start thinking about how we can rewire the insurance sector, and in particular sort of integrating part of the life insurance sector with health insurance markets, is that there's a whole sequence of events that could happen. First of all, it's going to lower the price of life insurance because now like people are less likely to die. It's going to increase the demand for life insurance because it's going to be a more valuable product, because in addition to having the payout to your family, it also has certain features of health insurance. It's going to increase the demand for life extending treatments because now we would be able to solve these like affordability issues. And of course, given the fact that R&D follows profits, it's going to stimulate further like innovation, and as a result, sort of like a virtuous cycle is going to emerge. Now, these ideas, even though in our research we've studied cancer so far, they're much broader, and it's sort of easy to see once you sort of get the reasoning how there's lots of other applications once you start thinking of insurance companies as being much more active, sort of like equity holders in their policyholders' lives. So let me sort of finish with one example, which is in the context of long-term care insurance. So in that case, imagine that innovative treatments become available that slow the onset of Alzheimer's or Parkinson's disease. Then by slowing the entry into long-term care facilities or nursing homes, it would benefit long-term care insurers. And so then once again, sort of like integrating sort of like certain features of health insurance, in this case with long-term care insurance, could help sort of like improve those markets. And so hopefully there's a way to sort of think about how those ideas could be implementable implemented in practice. Thank you very much again, and I look forward to the comments by Ellen and Moda.
Thank you so much. So we will have discussions by Helen and Motto now. Helen, I see you have just joined. Are you ready to jump in right now? Or do you prefer if Motto goes first?
I think probably better if Motto goes first. Sorry, I was in a
That's good.
trance. Thank you.
Normally it's ladies first. That's why I'm asking. Okay, then Motto. Floor is yours.
Hey, thank you. Let me share my screen. Okay, thank you for the opportunity to discuss. I want to congratulate Ralph on this wonderful award. And it's been a real pleasure working with him all these years and getting to know him really well. So this is based on some joint work that Ralph and I have done recently. So our 2020 NVR working paper on exchange rates and asset prices in a global demand system, as well as the 2021 Journal of Financial Economics publication on inspecting the mechanism of quantitative easing in the euro area. So I just wanted to kind of highlight some of our findings from this research as it relates to the low rate environment. So one of the things that we focused on is the role of fiscal and monetary policy in a low rate environment. So in particular, QE, as well as purchases of central bank purchases of foreign assets through foreign exchange reserve operations have made quantities of debt relevant in the current policy conversation. And because these policies happen at different points in time across countries, then you get these cycles in the relative quantity of assets across countries that have powerful implications for asset prices and exchange rates. So when your country is doing more QE or reducing the supply of debt outstanding, that can cause the domestic asset prices and exchange rates or currencies to appreciate. Okay, so illustrating this in a figure, what this figure shows is for each kind of major currency area, so the euro area, Japan, Switzerland, and UK, the x-axis is the quantity of debt, government debt, in each of those countries relative to the quantity of debt in the US. Okay, so for example, if we look at the euro area panel, 2002 is a year in which the quantity of debt in the euro area was relatively plentiful relative to the US. And then once you hit these years, 2015, 16, 17, when the euro area was doing the QE, then you have less debt outstanding in the euro area relative to the US. And on the y-axis is the relative bond price inclusive of the difference in the nominal exchange rate. So what you get is asset price appreciation in the euro area precisely in the years when the euro area is doing its QE. Okay, and some of the appreciation comes from bond prices having higher market values relative to face amounts or lower yields. But approximately half of it comes from appreciation of the euro relative to the dollar. And this kind of pattern holds kind of bilaterally relative to the US, also in Japan, UK, and in Switzerland. So another thing we found in the same paper was the fact that if you look at sovereign European sovereign debt crisis, okay, and what explains during that time, what explains the dramatic bond yield movements in Germany relative to the US, as well as Southern Euro countries relative to Germany. We have a technique called demand system asset pricing that allows us to decompose movements in bond yields into how much of it is coming from changes in the macro environment versus short-term rates, monetary policies, quantities of debt, foreign exchange reserve, and what we call latent demand. So movements in asset demand across countries that's not related to macro variables we observe. This is a simple scatter plot that illustrates what comes out of the demand system. So this is just raw data. On the x-axis is the quantity of German long-term debt relative to the US debt. On the y-axis is the relative bond yields in Germany versus the US. Okay, so again, in the Euro QE years 2015, 16, 17, the quantity of German debt outstanding is low relatively to the US, and you get lower bond yields in Germany relative to the US. We can formally decompose those yield curve movements into how much of it's coming from monetary policy, like short rates. About 53% of the relative bond yield movements can be explained by short rates, 15% by quantities, and 20% by foreign exchange reserves. So what's kind of interesting is if you're looking at the relative yields in Germany versus the US, most of it is explained by kind of like policy variables, right? Relative monetary policy, either in the short rate, quantity of debt, or reserves. And very little is left over in terms of how much the remaining variations explained by investor demand, latent demand, that's 14%. Now, if I look in the Euro area and compare Southern Euro countries relative to Germany, macro variables explain 64% of the relative yield movements. Monetary policy by construction almost, right, explains 0% because we have a common monetary union, right? So the short rate is exactly the same within the Euro area. So what's left is either macro variables, right, or fiscal policies, quantities of debt. So those play a major role in explaining Southern Euro countries relative to Germany. Okay, so if we look at the Euro QE that followed the sovereign debt crisis, we estimate that the Euro QE actually decreased government bond yields in the Euro area about 65 basis points on average through 2017 Q4. So that's the total effect of Euro area QE through 2017 Q4. But these effects were actually heterogeneous across countries because the purchases were proportional to the capital key rather than debt outstanding. So some countries with relatively high population shares, right, got bigger purchases relative to the amount of debt outstanding. Okay, as a consequence, you get heterogeneous yield effects across countries. And one of the key channels through which QE could affect financial markets is that it could recapitalize financial institutions by making their assets more valuable. Okay, so we estimated those effects in this table. So we split the countries into what we call non-vulnerable versus vulnerable countries. And this is to protect the confidentiality of individual countries' data. So we had to group them into two groups of countries. But we also have reported by sectors, right? So banks, mutual funds, insurance companies, pension funds, households, others. And then in panel C, we have the foreign sector, right? Foreign investors. And in the last column is our key estimate of like how much did the assets of these institutions and these countries gain as a consequence of lower bond yields and appreciation of their government bond portfolios. Okay, so you see that there is evidence that the Euro QE had a pretty powerful effect on the balance sheets in recapitalizing these institutions, not only in the non-vulnerable countries, but also especially in the vulnerable countries. You see these capital gains. Now, what's kind of interesting is because foreigners were actually major holders of Euro area bonds, they also appear to have gained from this capital gains channel. Right, so that's all I had prepared for my remarks, and I want to leave some time open for Helen to take over. Thank you very much for your attention.
Thank you very much, Moto. Should I, Luc, you want to?
Yes, please, go ahead. Go ahead, Helen, thank you.
Very good. So the first thing I want to say is that I'm sorry I was late to join you because of a prior commitment, but I absolutely wanted to be here to very warmly congratulate Ralph for this wonderful prize. And I had the extreme privilege of having had Ralph as a colleague for some time. I do miss him now. And I can say he's both an extraordinary researcher and also a wonderful colleague. So Ralph, really great congratulations. And now I'm just going to comment a little bit broadly on the themes of low rates and risk relating to Ralph's work, and also broadening it up to maybe financial intermediaries I'm a little bit more familiar with. And I would start by saying that when we think about low rates, so obviously we could all have a long discussion about determinants of real rates now, etc. And I'm not going to go into that, but we also think about rates in terms of monetary policy and how we think about the transmission of monetary policy into the real economy and via financial intermediaries. And in a lot of our traditional models, we did not have that much handle to think about the transmission of monetary policy via the financial sector, and how a low rate might lead to situations where aggregate risk is increasing, or transmission via the risk-taking channel of monetary policy. If we think about neo-Keynesian models, which are very useful for some types of issues, obviously they are not very well adapted to think about monetary policy transmission via the risk channel. We do have another set of models which link monetary policy and rates to financial markets. And there we have a lot of very interesting theoretical contribution in macrofinance. Some of them we can think of as the credit channel of monetary policy. We can think of the way rates interact with collateral values, with balance sheets, net worth, and this will give us a lot of the insight of the macrofinance literature, with the external finance premium affected by monetary policy, for example. But we also have some work thinking about the risk-taking channel of monetary policy, maybe a bit more to the point here. And there, the emphasis is about how risk interacts with leverage, how low rates may lead to a lot of leverage in the financial system. And here I'm thinking mostly about banks, and of course, Ralph and Moto here have worked a lot on insurance. But I think as Moto's discussion has shown, Ralph and Moto's work is really key to estimate the effect of monetary policy on asset prices, on the balance sheet of many different financial intermediaries, whether we are talking about asset managers, we are talking about hedge funds, we are talking about banks, etc. And their approach is extremely important to understand better valuations and the role of different types of financial intermediaries, the role of their different balance sheet constraints in shaping the dynamics of valuation, and in shaping effectively how monetary policy may affect all that, and may increase systemic risk or decrease systemic risk. So I think of their work as extremely important in that regard. Now, if we think about of course, their work on insurance, so there's a specific set of issues. Insurance have very different types of duration gaps than banks. And they have done a lot of work on various issues, variable annuities, and so on. In terms of the banking system, I would think that here there's a lot of systemic risk which builds up via a leverage. So this is a bit different, even though actually this is something also I would like to hear Ralph and Ralph's view on the synthetic leverage that is building up in the balance sheets of various types of financial intermediaries. When we have asset managers, we have hedge funds who might use derivative positions to build synthetic leverage, and this seems to be happening more in low rate environment. So this is, I think, something that is quite important to keep track of these days. And in terms of life insurance companies, also we tend to think of the money that is put in these insurance companies as being quite sticky, but is it really the case? And indeed, if we have a path of increasing rates, or even if maybe even more so if we have abruptly increasing interest rate, is it the case that the money is not, we may not have something a bit akin to a run for life insurance company? So how should we think about stability in the insurance sector, and a little bit in a parallel way to how we think of, or we used to think of, bank runs? Now, if we look at the transmission of monetary policy, so here this is going to be data on US monetary policy. I think what is very clear is that when we have low rates, when we have a loosening of monetary policy, so this would be the opposite of what you see here in the green in the grid areas. We have a loosening of financial conditions, a loosening of world private liquidity. So here, because I have put a tightening, sorry for that, you see exactly the opposite. You see a tightening in world financial conditions, a tightening in world private liquidity. You see an increase in the VIX. You have to flip the sign. But it's pretty clear that monetary policy and low rates have an effect which is quite powerful globally on valuations, on liquidity, on financial conditions, and even on the VIX, which represent both expected volatility and risk aversion. So risk taking is influenced, if we want, by low rates, and not only valuations, but also quantities. So if we think about flows, so when the rates go up, inflows into the US, outflows into the US both go down. So the amount of financial transactions go down. When we look at emerging markets, and that might be very relevant with the current macroeconomic conditions we are facing now, when the US monetary policy tightens, inflows to emerging markets go down, and here outflows go up. So it's asymmetric, the reaction between advanced economies in terms of inflows and outflows and the reactions of emerging markets. The emerging markets face effectively net outflows. So this is another, I think, risk that we are facing after a long period of low rates and a long period of balance sheets build up, essentially. The tightening of interest rate might have dynamic effects which are very asymmetric for advanced economies and emerging markets. Here I'm just reproducing so that everybody can see it in a big picture, the effect of a tightening of monetary policy for the US. It increases any measure of risk aversion you want to put there, the VIX or others constructing measure of risk aversion. It decreases valuation of risky asset prices globally, and it also appreciates the dollar. So if we look forward if we look into the future and we think there's a tightening of interest rate coming up, so we can think of what are going to be the effects of risk aversion going up, of valuations going down, and an exchange rate appreciation potentially on balance sheets of different financial intermediaries. And I think that's a very important thing to think through right now in the current macroeconomic condition. Okay. Now, if we look at banks specifically, whenever there is a tightening of US monetary policy, this shows up in a decrease in leverage, both of US banks within US banks border, so that would be US brokers and dealers, but also this propagates to global banks. So this would be the EU banks leverage going down after a tightening. This would be broader aggregates of US banks beyond the broker dealers and broader aggregates of EU banks. So we see that there is a kind of tightening going through the system with first the capital market banks leverage going down, and then the broader aggregate of banks going down as well in terms of leverage. So strong propagation via the banking system. And obviously it would be interesting to think through more what the tightening of monetary policy, so fluctuation in rate, does to other financial intermediaries. And this is something that I haven't seen the type of impulse response function that I'm showing here. So to finish up this remark, I think here I have interpreted the rates as monetary policy rates largely. Again, as I said, we could have a discussion on the level of real rates, etc. But I've discussed here mostly rates in terms of monetary policy rates. And what I've tried to show in a lot of these impulse response function is the great importance of these monetary policy rates to drive valuations globally, to drive risk premia, to drive leverage of banks, to drive capital flows. And indeed, I think there's a lot missing building on the work of Moto and Ralph to extend this type of issues to other financial intermediaries. Okay? And I also think that to build on the work of Moto and Ralph, one thing that we should think a lot more is about the interactions between the level of rates and the level of regulation that we have in various financial intermediaries. So here, again, most of my work has been on the banking sector, unlike Ralph and Moto were focused on insurance a lot. And if we think about the interaction between the level of rates, the amount of liquidity, and the regulatory stance, I think it's very important, that interaction, especially, to explain the level of risk-taking that has been going on in the economy. So here, let me just discuss briefly this graph, and then I will stop. So here, what we have in a paper with Nunu Coimbra and Dae-Soon Kim is that we have reconstructed an index of risk-taking using bank-level data, balance sheet level data. So we have recovered value at risk parameters for various banks. And with that balance sheet level data, we have constructed this index of risk-taking, that's the blue line. And when the blue line goes down, it means there is an increased risk-taking in the aggregate banking sector. So the blue line going down means more risk-taking. And we have looked at the time series of this index of risk-taking in the banking sector and put here a few of those important regulatory events in between 1993 and 2008. So you see there, these are mostly deregulation events, except for Sarbanes-Oxley. But we have a lot of deregulation going on at the same time as we have essentially a lot of liquidity, low financing costs, low rates in the macroeconomy. Very important here, a change in the net capital rule for investment banks, for example, and we see risk-taking increasing continuously, essentially until the great financial crisis. This red line is not doing anything before the 2008 because this is the macroprudential policy stance, and essentially macroprudential policies did not exist before 2008 in advanced economies. We see after 2008 some re-regulation and also some macroprudential policies being put in place. And as you see risk aversion starting to go back up. So risk-taking starting to decline a bit again, despite low rates here, but it's a regulatory tightening that is going on here. So I think it's very interesting and important to think through these interactions between rates and regulation to understand the dynamic of risk-taking. In the banking system, I'm fairly sure about that. And I think for other intermediaries, there's a lot of work that could be done along those lines. So let me stop here and congratulate again Ralph for the great work and all the important ideas he brings to the table precisely to think through all these issues.
Thanks so much, Helen. And thanks for making my life as chair easy here by finishing on the dot. Ralph, would you like to take a moment to reply to Moto and Helen? And then I open the floor to all of you who want to ask Ralph or the panelists a question. Please add it in the chat or just indicate it with a raise your hand sign. So Ralph, back to you.
Sure. Well, thank you both, Moto and Helen. This was great. Let me comment sort of on Alain's sort of like questions because I know the graph Moto showed quite well. So this is based on our joint work. So this is, let me focus on sort of like two points that Alain mentioned that I think are really interesting. So one, one is sort of like what would we expect to see, or what could we expect to see, and Modo can sort of jump in on this as well. If interest rates sort of like suddenly were to rise, and could we see something like a run? And I think there's sort of an interesting possibility there in the following sense that if you think about what happened sort of over the last decade or so, is that all the variable annuities that have been sold, they have lower levels of guarantees in them. They were sold at higher prices. And so suppose interest rates would like rise sharply, then all of a sudden it's feasible for insurance companies to offer sort of the variable annuities at with higher levels of guarantees, at least nominal guarantees. And so what is possible is that sort of like they start using so-called exchanges where they start sort of like chasing each other's like policies, and try to sort of attract sort of like old policyholders and try to like switch them over into new products. To the extent that the asset allocation is different between the old products and the new products, you could start to see sort of like shifts in terms of the asset allocation. So I don't know whether that's whether that may or may not happen, but that's sort of like certainly something that is feasible, I think. In terms of like leverage of hedge funds, and why it is important, I think it is, and this relates a bit more also to some of the work that I've done with Xavier Gebex. So trying to understand the elasticity of the whole market. So one of the things that sort of we argue there is that the market as a whole sort of is like seems to be quite inelastic, and meaning that fairly small shocks to demand or flows have a large impact on prices. And there, what you see is if you look at times of stress, where you would think that sort of like someone, if prices fall like a lot. So for instance, take the COVID crisis last year, like prices fall by like around 35%. That means that if you turn it into fundamentals, it means that sort of like you would expect sort of corporate America not to pay dividends for the next 15 years, which seems very extreme. So prices respond way too much relative to fundamentals. And so you would imagine like someone would step in, and so the macro hedge funds would be the first group that comes to mind to step in during those times of stress. So quite surprisingly, what you see is that they are actually amplifying the shocks, and so you see outflows out of equity markets from hedge funds, which is in part driven by, I know, very related to your work on like value risk constraints binding, and those hedge funds receiving sort of equity or sort of outflows themselves. And so to the extent that sort of like their leverage has increased and their sort of like sensitivity to shocks has increased as a result of that in the low rate environment, I think it's certainly sort of like very useful to monitor that, perhaps not only in equity markets but also in credit markets. So let me stop there, and maybe Modo wants to add something as
well. Modo, did you want to add something to what Ralph said? No?
No, that was great. Yeah. Are there questions from the audience we should take at this point?
Yeah, so one question is coming in from Jose Luis Pedro, and he is asking actually all three of you, but I guess first and foremost, Ralph, what your thoughts are on low rates and universal banks. Since Ralph and Modo, you spoke mostly about insurance and Helen mostly about banks, but there are these financial intermediaries out there, especially here in Europe, that actually combine both, sometimes starting out as insurance and gobbling up banks, or the other way around. And what are sort of pros and cons, and what are sort of implications of low rates for those type of entities? Do you have any views on that?
I think it's a great question. It's not something we have looked at. Like in the US, this is not very common. So a lot of our work has been so far in the US, in part driven by data sort of like limitations. Now, one of the good things of Solvency II is that now we have good data on European companies as well. So we started to look at that. And so it's certainly one of the things we could look at. At this point, we haven't sort of like looked very much at all at that. And so to what extent sort of those different parts of a universal bank sort of like would be hedged or would be hedging one another, or whether those things are correlated, I don't really have a good sort of intuition for that. So at this point, I wouldn't be able to sort of say like much more beyond that.
Yeah, so to add to that, in theory, it could be a good thing in terms of reducing the duration gap. So I tend to think of banks as having positive net duration, and then insurance as negative net duration. So if you combine them in a universal bank, then they can offset the duration gaps with each other. Now, the reason it doesn't happen in the US was, and the lesson is from the 2008 financial crisis. Some insurance companies actually tried to become a bank holding company in order to qualify for TARP. So TARP was only available to banks, but some insurance companies that desperately needed capital tried to qualify for TARP by acquiring like a bank and becoming a bank holding company. But then they subsequently backpedaled because they realized that becoming a bank holding company comes with additional capital requirements. And this relates to what Ralph was talking about, which is kind of the liquidity and capital requirements that are appropriate for banks may not be for insurance companies that have long-term liabilities. So both from an economic perspective and also from the perspective of insurance companies that don't want to necessarily tie their hands with additional banking regulation, for those reasons, I think it is hard to get that to happen in the US.
Yeah, I mean, I think the point on duration being exactly complementary is an important one. And indeed, I think in the interest rate swap market, you would see that the counterparts are indeed the insurance companies versus banks for exactly that reason. So what is the advantage of then having a kind of corporate entity which is all-encompassing versus using the market? This is, I think, an interesting issue. Yeah, I'm not aware of much research on that, so that sounds like an interesting area. There's also interesting potential complementarities or things to study in the mortgage markets, with the insurance being given to the people who take mortgages in some countries and sometimes being extended by some banks. Or entities linked to some banks. And so that's also an interesting one, I think, to look into. So yes, a lot of interesting potential questions there.
Actually, just to add to what Helen just mentioned, insurance companies used to be the major originator of mortgages in the US, and that relation kind of flipped in the 60s, 70s. So now, but if you think about like the old way in which the US financial system worked, if insurance companies were the major originators and holders of mortgages, that might actually be better from a liquidity perspective, right? Because you want to match illiquid assets with illiquid liabilities. And kind of the current arrangement of putting all those mortgages in the banking sector might actually be more fragile than what we used to have in the US, which is insurance companies were the holders of mortgages.
Okay, that goes back to the point whether we can expect any run or not on insurances.
Well, there's a related argument to that, actually. Like on the whole, if you think to international finance, like there's this argument that like we now have this breakdown of like covered interest rate parity and these big deviations somehow. And that's kind of a puzzling fact that if you look at the largest insurance companies, they hold like bonds in lots of different countries. Like AXA holds like bonds in the US, they hold bonds in the euro area, and you would think they would arbitrage that very naturally. And so why would we sort of like have all the intermediation being done by broker dealers with like very tight constraints, when we have other intermediaries like insurance companies who are sitting on these massive amounts of bonds as inventory, but are not doing the intermediation? And so if you would integrate those, all of these constraints simply wouldn't, it seems sort of like wouldn't matter as much, because they simply have these bonds sort of sitting around anyways. And so there's certainly complementarities you can think about, but it seems like an area ripe for research.
Yeah, that's a great point. I'm wondering if that's a consequence of the regulation as well, in the sense that if U.S. companies were to hold like foreign bonds, I don't know how that gets treated in the capital requirements, but unless they if they need to hold more capital against foreign bonds, then that arbitrage might not happen.
And also, and how the derivatives are accounted.
Yes, the derivatives, exactly.
So if you want to, you can probably increase and decrease the amount of bonds, but then if you want to put on the derivative to sort of do the hedge, then that's the one that may be costly. But again, like it suggests sort of like thinking about having an integrated approach on regulation, which maybe we haven't talked about, seems extremely valuable, because we have some institutions who have lots of these bonds and can do it very easily, but somehow maybe held back by regulation that is designed for banks, but like maybe maybe inappropriate for insurers.
The insurance subsidiaries may not even be able to lend and borrow bonds from each other, right? Because these balance sheets are kind of locked up within countries in order to satisfy the statutory reserve requirements. That's a problem, yeah.
Thanks to all three of you. So there's also a question from someone in the audience who's probably at the receiving end of some of these regulations that you're speaking about, and you spoke mostly of from a sort of good perspective. But so if you're at the receiving end, let's say you're a banker or an insurance company, then over that whole period, Ralph, that you have been doing research, and they've been living with all these threats and new regulations, intensified competition, as you said, macroprudential regulation, as Helen focused on, security breaches, etc. So let's say to the bankers or insurers in the audience, is there anything from your line of research that you could share with them as to how they should face these threats? This is a question from Fadwa Bakali.
Yeah, so it's not so clear. I would sort of like put it as like those threats. I think there's a lot in what you're saying. So obviously, I think the whole concern about cyber risk and security threats and stuff like that, that's a whole different sort of can of worms. Compared to sort of like new regulations that are put in place to make sure that the system is like sort of like sound. Those seem to be sort of like different questions. I think what is important though is to have like a clear set of guiding principles in terms of like what drives regulation, and sort of follows through on that sort of like, and instead of there letting be a lot of uncertainty about sort of like what regulation may or may not be. And so I think in like whenever there's regulatory changes, at least sort of like speaking more about the US perhaps, there's been a lot of discussion about how to implement macroprudential regulation for insurance companies, in part because the state level system is so fragmented, and it's sort of like been discussed like for like a long period of time. Very little has been like implemented, and so that sort of like policy uncertainty, that seems like something that one wants to avoid. And starting from like a clear set of principles and try to sort of like follow through on that, maybe one way to sort of like get a little more clarity and less uncertainty about
that. Helen or Motto, anything to add to that?
No, I do think that we know very little about the new types of risk. So we knew very little about cyber risk. It's very hard to understand the full ramification of potential big cyber events, and therefore it's also very hard for macroprudential authorities or bank supervisors to be fully equipped to try to deal with that. So I think, unfortunately, that's something there will be some learning probably. It's also very hard to understand the effect of the big issues that is going to be with us for a while, the climate change. And here there's also a lot of potential interaction between the banks and the insurance sector. And we can definitely, we are just scratching the surface in terms of the potential interaction between the balance sheets of these two types of intermediaries. If you think about both the transition risk and the physical risk, it's likely that they're going to affect the loan books of banks in non-trivial ways looking forward. But also how much the banks will be affected will depend partly on how much insurance coverage there will be for physical risk and such issues, and how dynamically this will change over time. And I think this is something that, again, we don't fully understand. I mean, I don't think we can understand, in fact, because we have not experienced, we don't have historical data on that. But that means that the network effects there, the balance sheet effects, may be important to monitor. And we have to start having analytical frameworks and going with the data we have and trying to have more relevant data as much as possible. We lack geographical data on many dimensions at the plant level to be able to have a real view of of where the physical risk, how they will develop and which supply chain they will affect, etc. So it's a huge amount of work in front of us, and so I think there, there will be more regulation. We just don't know exactly how it will play out, but that's a big challenge.
I want to agree with Helen that a major thing is data. So insurance companies are hesitant to insure risks, like for example, cyber risk, where they don't have a lot of data that they can rely on in order to estimate the risks and price these risks appropriately. So Ralph and I mentioned this in our forthcoming book, that one way in which governments can help is to be kind of a central source for gathering data, for example, on cyber breaches, maybe anonymize the data and then make it publicly available. So both insurers and investors can price these risks appropriately. Right now, I think because like data is monopolized and or firms are reluctant to share data where maybe there was a serious breach, it becomes very hard to insure these risks. So I think governments can play a major role in facilitating insurance of these emerging risks by trying to make the data available to players.
Yeah, right now there's not an incentive to report.
Exactly.
That's for sure. So yeah, that's why it's, can try to get data from other sources such as analyst calls or stuff like that. But it's yes, there's a big data gap on this.
The broad thing that Mona mentioned, which sort of relates to I think everything we talked about, is sort of like I think one of the things that sort of emerges from our research is that sort of like any form of aggregate risk in the loss distribution is going to hold insurance companies back from insuring certain risks, and this could be truly physical risks that we just don't know how the climate's going to evolve. But there's other aspects. If there's behavioral responses because firms don't want to like report certain data, or if there's uncertainty about how policy will respond to like large climate disasters, then that sort of like is going to amplify those risks and it's going to sort of like hold back insurance markets. The other way that may help is sort of like if governments are willing to take the absolute tail risk of these risks. So we've seen in the past that that's sort of like providing like a reinsurance of the extreme risk. Maybe really important to get those insurance markets going, so you have a functioning market for all the risks up to a certain like level of like aggregate shock, and governments have to sort of be the ultimate sort of like backstop of that. So there's lots of things to think about in the context of climate and cyber risk, I think.
Thanks. So a couple more questions. It's a great question by Benoit Mongeon, and I'll leave them to Ralph for you to enjoy during the break. I'll pick a question from your friend Stein van Nieuwenburg as the last question, and here I would really, this one is just for you, Ralph. It's a very appropriate question. So his question is the current, first he says congratulations, and I think that's very well placed because, as many of you know, Stein was a previous recipient of the Bernassa Prize. The question is the current macro regulatory framework in insurance market appropriate for the current environment? If you were king for a day, which basically you are in our little event, how would you change it?
Yeah, so let me speak about sort of the US framework, which we know well. There is no macro-prudential framework for US insurance companies. So the answer is short. So like it seems very natural if you start thinking about, so like the US system is very like fragmented because it's state-based regulation, and so it seems very natural to start thinking about, and Modo and I sort of like discussed this in our book, sort of like start thinking about standardized stress tests for banks, to make sure that those stress scenarios are consistent with other parts of the financial sector, so that those stress tests sort of like connect with whatever stress tests people are running in banks and things like that. At this point, this is not something that's being done in the US. In Europe, there are stress tests of that type, and so lessons can be learned there, I think. But yeah, those are like sort of like important starting points. But at this point, yeah, there is very little of that in insurance, unfortunately, despite their size and importance, I think.
All right. Ralph, Helen, Motto, thank you so much for lively discussion. And to Helen, Motto for discussing Ralph's work. So we will now have a short break of, 9 minutes. The program will continue at 1800 European time sharp with the award ceremony. Ceremony will be chaired by Pablo Hernandez de Cos, the governor of the Bank of Spain, and he will be joined by Luis de Guindos, the vice president of the ECB, and he's also the chair of the Bernassa Prize Selection Committee. And he will start by giving the laudatory speech. That will be followed by the handover of the prize diploma to Ralph, and Luis Isasi, the president of Santander España and also sponsor of the prize, will take care of that. So thank you, and see you in 8 minutes now. Bye.
Thank you, Luke, Helen, and Motto.
Well, pleasure, Ralph, really.
Okay.
Hi, Moto.
Total pleasure. Total pleasure. Thanks.
Are we staying on that link or no? We are staying on.
There is another link.
There's another link.
We
Okay.
will be downgraded to audience, I believe, Helen. But Ralph will, I don't know what happens to you, Ralph.
I'll try to be there.
Try to be there.
Okay, see you in a bit. Thank you.